one of the DFIs themselves, the key DFI, as we saw in that graph that you presented earlier, William. So thank you very much. So Andre, you have the floor.
Thank you very much, Sam. So I'm going to talk about how climate business is first organized across the IFC. Basically, it addresses the different industrial as well as financial services aspects of climate, whether it's dealing with green buildings, whether it's dealing with the manufacturing sector, or with the provision of power, as well as in the agribusiness. But it is, for us, a critical aspect that we have to work also for smaller scale projects, those projects that IFC couldn't do directly through local financial intermediaries. And we feel that involving local financial intermediaries is critical, particularly to scale up their involvement, to scale up a private sector response dealing with small and medium-sized enterprises. Because we cannot do that, say, from Washington, even though we are decentralized, say, from Istanbul, Cairo, and the like. So there is always an element of proximity that is going to be very important in dealing with climate finance, especially if you want to reach a certain degree of capillarity. So I'm going to talk and reflect also on the concept of leverage that was so well explained and covered by Jessica Brown's paper in dealing with what are our activities through financial institutions. And you can see here I'm going to be talking about all work through FIs, financial intermediaries, including private equity funds. That is what I represent today and what I want to delve more into. To give you a glimpse of what that represents, well, last fiscal year, for example, that's a business that was just shy of 500 million. But our goal is to do now to really dramatically scale that up and to reach about 1 billion per annum on a fiscal year basis. So again, this is an area we feel has to grow and is growing rapidly through the backing of our senior management. This gives you an illustration of why we do this, because we have a large network of financial institutions clients, about 600 worldwide. And this chart gives you an illustration with whom we have worked specifically, excluding trade finance, to gain the exposure we have today in our portfolio. So you can see it's a large exposure. It's about $1.5 billion, and primarily through 25 partner financial institutions, excluding trade finance for the importation, for example, of climate-friendly technology. As you can see, this activity spans the globe. And again, why we have certain financial institutions is because sometimes you find a strategic alliance in these particular goals dealing with climate finance. I want to give you an illustration, again, placing all of this in the context of leverage of different type of instruments that we're using to promote climate finance through financial institutions. Obviously, trade finance, dealing primarily with the importation of energy efficiency or renewable energy equipment. Sometimes we can also extend that in working through supply finance or vendor finance schemes. So that is, for example, extending a direct collaboration with the likes of ABB or Siemens of the world, dealing with their renewable energy branch, for example, or working through dedicated credit lines then to have the refinancing of trade lines. There, the leverage factor remains rather moderate, obviously, for long-term credit lines. But there is an aspect of long-term credit line that could be helpful, in particular when you deal with local financial institutions, is that they might be very liquid, but they might lack funding for longer-term maturities, which are particularly necessary if you're dealing with renewable energy projects, because the payback period is way beyond, say, the window of 5 years classical commercial finance, and hence extension of maturities or maturity transformation is essential for local financial institutions. Then you have risk-sharing facilities. Typically, at the inception of our activities in climate finance, local financial intermediaries might require coverage. As well as our competencies in having dealt with particular technologies and transferring those lessons in different parts of the world. And at the end of the leverage, with instruments which provides you with a greater leverage working with financial institutions, are subordinated risk-sharing facilities such as mezzanine, as well as equity instruments, which aim to actually boost at the higher end of the risk spectrum the capability of local FIs to take on risk, knowing that whatever they put would be in a higher risk, in a lower risk tranche, because they would be senior to the risks that IFC, and as well as donor monies in structured finance vehicles are going to be underwriting. So there, that's typically where you get the most prominent leverage. But those facilities take more time to structure and to roll out. But once you have the technology, it is possible, however, to scale them and transfer from one region to the next. This is an illustration of the leverage factor. Actually, when you go from direct finance of a large-scale project to structured finance, where you have different schemes of risk subordination, very much something that's illustrated again in Jessica's paper when you're talking about the funds, the KfW Climate Partnership Fund, in which we have been a structuring partner and investor. You get much greater leverage because you're able, through the project structure, to finance a number of underlying projects. So that's an illustration of optimal leverage. Because you have at the seed, if you go to look towards the right-hand side of the screen, you have an initial government subsidy or grant that could be considered high risk capital that allows the project to take on risks and actually attract private sector investors, knowing that they are going to be senior in the investment instruments. That is probably the ultimate at this stage in terms of financial technology to attract private sectors en masse, so to speak. And IFC is doing this for climate finance projects, and we have done this in the past, that type of approach, when dealing with other asset classes that needed a boost, namely microfinance. This is an illustration again of the type of leverage you can attain through building on the equity from donors. And again, I want to address something that Dirk was saying, is that there is an inherent subsidy in IFC's stamp of approval in working with projects, but nonetheless, as you also pointed out, we're managing a balance sheet. We have a AAA rating that allows us to mobilize capital through bonds at a lower cost and be able to pass on that lower cost to our borrowers. But we must preserve our AAA rating. There is no doubt that even though we are venturing each time into more difficult country environments, we have initiatives, for example, for conflict-affected and fragile states. This being said, we have a responsibility to our shareholders, the member governments. which means that sometimes to launch new activities, we rely on seed and donor funding from our member governments, such as DFID, such as the Dutch, for example. And we are doing so, and I'll give you a concrete example, in a particular climate initiative I am currently involved in. And that's this example. You haven't heard about it yet because this is something that we are busy setting up. We're working with the EIB on rolling out an East Africa climate facility. What are we talking about? It's a 60 million facility. And I took this example as particularly relevant for our debate today. Why? Because in the 50 million euro, you have a 10 million that is coming from official sources, 5 million from the European Union, and 5 million euro from SIDA of Sweden. And that element will allow IFC to take on and to roll out climate finance solutions to financial intermediaries, starting with Kenya, then Uganda and Tanzania. And why do we need to have donor funding and provide it a significant leverage of 5-to-1? Well, we need it because there are some elements to entice local finance institutions to take on risks in energy efficiency and small-scale renewable projects. We have sometimes, we anticipate that we will have to take not only a pari passu guarantee, but possibly underwrite on behalf of the local financial institutions a first loss, meaning that if losses in their renewable projects or in their energy efficiency agenda are hitting their balance sheet, it's not going to hit theirs, but first ours. But we can't take it on ourselves since we manage our balance sheet. So that is the element of the subsidy coming from official sources, from ODA. In this particular case, EU and SIDA. What is interesting about this project is that we really have taken a different approach. We have actually talked to individual financial institutions. We ran a seminar actually last week, and we told them this is what we want to do. However, in terms of products and financing solutions, we leave it up to you. Tell us what your balance sheet structure is. What is it that you need? Is it to go beyond 5 years for renewable projects? Is it that you don't understand what renewable risk is made all about? And then also working to develop a pipeline with financial institutions and true energy experts on the ground to say, if you take this industrial sector, if you take the tea sector, for example, which is very relevant for Kenya, what is it that you can do? Because we have done this background studies on each industrial sector to tell them these are the concrete opportunities that you can support to reduce energy dependency of the tea sector, to reduce the energy consumption of the tea sector, and then provide them this technology costs so much, the payback period is this short or this long, hence this is the pipeline. What will you do to provide financing to this project? Or what will it take for you to become an active lender in this field and scale up the response from local financial institutions. And there is a TA package to really boost the underwriting capabilities of these local FIs. I want to reflect on Jessica Brown's paper, and she was having a description, which I think is extremely relevant, of the type of risks that would stop financial institutions or the private sector to be active investors in the fields of climate finance, RE and EE. Well, I would say that if it's IFC dealing with local financial institutions, most of the risks do not apply because we're already understanding what the general political or country or currency risk are. Since we work already, we have an established asset base within these countries, sometimes with even conflict-affected and fragile states. However, what really we try to do is to address the execution risk. And that's where I think our presence can really mitigate risks on behalf of financial intermediaries. Hence, that's why I put it in red. That's really where the impact of such a facility is most felt. And this is just to describe that working with us is could be good for donors, because obviously we try to maximize the impact on climate finance, but also what we want to do is scale up this climate finance business to new heights, with a view on capillarity, that is enticing as many as possible SMEs to have cleaner production and reduce greenhouse gases. And that's, in a nutshell, I hope I did okay with the timing.
You did very well.
What I
Andre.
wanted to cover.
Yeah,
Thank you
very much, Andrew. That was great. So moving straight on, Tamsin Ballard from DEC is now going to talk about the initiative which I believe Greg Barker, the Minister at DEC, has been driving forward, the Capital Markets Climate Initiative. Tamsin's going to go to the computer there.